Hey, good afternoon, everyone. Good afternoon. So, we're going to do a multi time frame analysis. I just want to go over a few things with you. The market has rallied up 50% since the April 2025 low of 50.50. Right here, this is the Bank of Japan tantrum saying that they were, you know, at one point going to stop the carry trade. They did this when the markets were at the quarterly three and monthly three, knowing that they would break the market, and ran two times the quarterly range on that move before the dealers stepped in and said enough of your crap. Um, and then, of course, the market rallies up. Meanwhile, Berkshire sat in the repo market collecting interest on their treasuries this entire time of this 50% move from that low to the current high at 75.50. We had another dip this April, not as deep as the April 2025 dip, but we got out of this delta neutral situation from December through March, and we dipped lower below the quarterly ones, below the 6 month one. See that red is the 6 month one, all the way down to the quarterly three. So instead of going into the tails, we got down to the 6 month two and the quarterly three. So it left the 6 month one and it went to the 6 month two. I keep telling you, if it leaves the one, it's where does it go? That was my light bulb moment when I looked at my, one, two, threes. Well, it's got to go to the two, right? It's not rocket science. And so here we came back inside delta neutral. So any short Vega firm would have wanted to trade that back into the delta neutral. And then it went and flipped above the quarterly one and went to the 6 month one again. There was like 13 days it finally broke out of it, sat in this little zipper, and went to the quarterly two, broke up, went to the quarterly three, and then look right here, 6 months two. So we went from the 6 month two on the bottom to the 6 month two on the top in like a month. That is insane, right? During a war, right? So I my heart breaks if these billion-dollar funds are breaking up, blowing up, imploding on it, but they've got to learn how to hedge, and they've got to learn when you're delta neutral or you're not. And if you're directional, anything above A1 is going to be hedged directionally by the funds, right? So right now we hit the 6 months too. Are they going to turn around and send it back to the mean, come back inside to the 6 month one for the end of the June? That's where we go to our options and take a look. And when I come over to the Quick Options website, pull up the VIX, log in, come up to VIX. You can see I just pretty much look at VIX and SPX, but and then next week through June 10th, really, you can see that the high GEX is at 20. And we've got long vol through June 10th. As of this moment, this can change. But for next week, going into OPEX and expiration, that 20 looks like it's going to be a pretty strong clue. And if they're hedged, that's a very likely scenario for them, since we've hit our targets, to hedge or allow it to come directionally back inside to this 72.16 or towards it. They're not going to go back inside. Um, they're going to be supporting that somewhere to go back to 17. So from 20 back to 17 for the end of June. They're going to keep it above that area because they're already hedged. So if we come over here to our VIX, you can see here that this is my monthly distribution, and they have been walking this monthly one line right here at 1670. So this is almost the 17, and then here's your 20. So between 20, 25, maybe where did that upper, here's your 20, 25, yeah. So between 2025, we'll get this action going, and that will bring the VIX back in. I mean, the ES back inside, but not back inside any further than that 72.16. They're out of the 6 month one, so that's hedge. That is your hedge. They're long above that. That's what I'm trying to say. So if you can figure this out and have your levels the same way that I can see them, it makes it a lot easier to plan your trades around this if you're going to be selling premium. The weekly is a good distribution in the ES to sell premium around. I set up my levels on the 1 period as well as the 14 period. The 1 period I call realized volatility or RVOL, and historical volatility is the 14 period. And so they hedge the RVOL, HVOL, open and close. That entire envelope is quote unquote the one, everything inside that. And so all of this was hedged. They're delta neutral right now, and they have been since, well, beginning of May. They've been delta neutral. Even this is delta neutral because this was a new week, and here's your upper one up here. So you just have to know where the vol is and how their flows are flowing inside of it. Whenever the 14 period is outside, or the 1 period is outside the 14 period, when the 1 period is inside the 14 period, it can really give you that confidence to stay with that delta neutrality. That, what is your probability? Delta neutral probability. That's my DNP. But if the 1 period is outside the 14 period, that can lead volatility higher. So I always watch my 1 period over my 14 period on a daily range, and that's what these are. I can create my oscillator to show me when that 1 period breaks a daily. I can do the same thing on a weekly and a monthly. So I know my hedge lines. I know when you're going to be outside or inside. on any time frame. And I can also show you to a high degree of certainty where they max out at. Look at that. Of course, always in a normal distribution. You get some sort of, news announcement or just flat out distribution like a COVID or something that changes. But normally in a normal distribution, you do have your edges and you know where those are. And that's how the dealers trade also. They know these edges and they'll sell it back to the mean. But for futures trading, picking up pennies on, selling premium, from the for the amount of money that you have to put in that capital account to be able to just hold that premium for the month, that small amount of premium that you collected is a losing trade in its own. They want to hedge. They make money hedging, right? That's why they break the ones. Because when the ones break, they're long directionally, that direction. So if it breaks above the ones or breaks below the ones, they're going to be hedged in that direction. And then you can come down on a lower time frame and trade pullbacks because you know they're hedged on a higher time frame long very successfully with futures. So here we are trading above the monthly one, trading above the monthly one, and went right up to the monthly three, and we've stopped out on the monthly three, and we're above the quarterly three, so we're hedged on that quarterly three also. So follow the VIX to 20, see what happens 25. Follow me because I'll be showing you these lines move on a daily basis. The volatility can be measured on the open of the month. So you have June 1st, that open, that daily open on June 1st will be cemented in all month. Those levels going on that variance trading methodology will be the same all month. So when you measure from the monthly open or the prior close, those are constant. They don't change. But the daily calendar days, so say June has 30 days, you start doing a 30-day distribution every day, it changes every time a new daily high or low breaks. You get a new distribution. You'll get a new daily high or low on that 30-day range. It shifts around. It's more dynamic. It's a lot more fun to trade a calendar day distribution. And because of that, you get, more opportunities. But just knowing when the big hedge funds are hedged allows you to come in after them, like reaping their rewards, because you know the way that they're sending the flows, and so you can lean in on that. So, yeah, it can be quite rewarding. Definitely come get the indicator. You will find that these are not back painted. This does not go back, right, to adjust itself to a volatility position that's already formed. These are real live levels that stay the same, and you'll see very happily that the market trades to the levels and responds to them. So, as long as you have a distribution, a variance trading model distribution, that you can accurately, measure the ones, twos, and threes on these time frames, you have a very decent shot at being able to put together a trading plan and then trading with the volatility with the dealer flow. Don't fight the dealer flow. Why fight it? You've got to trade with it. You've got to trade when you know that the dealer is eating theta, they're going to be sending you back to the mean, just chewing up the clock. You just sit out of the market whenever you're inside the daily one. It's just going to be chopping up and down inside small nothing days, right? But when you're positioned hedged on a higher time frame directionally, that's when you want to be perked up on your lower time frame and take advantage of any pullback to a lower time frame, one, two, or three, um, to get back positionally with that higher time frame move. However you want to do it. And the best thing about this is you can make your trade plan your own. You don't have to go exactly where everybody else might have an order parked. You can plant yourself inside this distribution however you like to make your trade plan. But just having the cipher, if you will, the Swiss Army knife cipher of what the volatility is going to give you a huge edge of alpha. And maybe the next time you get $1 billion of assets under management, you will listen to me and trade the dealer flow and stop blowing up. But it's okay, I've blown up accounts. It's not like, we haven't all done it. You don't really learn until you've made mistakes. And then I wanted to find out why I blew up, and I really dug in and figured all this out. So I think I've gotten myself to a place where I have a very comprehensive understanding of the market now and won't ever put myself in a position like that in the future because now I'm in line with the market instead of trying to fight it. So put yourself with a position, changes every day, it's dynamic. Trade with the VIX and volatility on your side. Learn when they are delta neutral. It's not going to do much that period. But when they are hedged, that's when we can start making a lot of money in the market because we understand their flow and we can capitalize leaning in on these one, two, threes, knowing where they're most likely to be coming in. All right, I hope y'all have a great weekend. Um, I think the war is going to be ending, so gas is going to start plummeting. Take a look at the crude real quick. I mean, this is another market you would think that it wouldn't apply because it's supply demand driven, but you would be wrong. It does follow greatly in line. Whenever you do get an overreach of a level, like right here, usually it'll stay inside the distribution. Like this is just the daily, and you can see that it stays inside. But when it does dip down, this was May, and here again, May 20th, you can look at the higher time frame, and here you'll see that dip down to the 7-day one. There's always a reason it's reaching for a higher time frame level, and that's where they picked up the hedge. They picked up the hedge to send it back in delta neutral. Look at that. I mean, it's amazing once you start understanding what you're doing. Look at that. Went right there, 50%. I mean, I'm not making this up. I mean, this is real. This is real volatility. This is real price action from this week. So, so yeah, I mean, definitely it's tradable. I hope y'all have a great weekend. And we're going to just tank. We're going to get the oil down so low. It's going to break this monthly one and just collapse. We're going to get down to this lower quarterly one. It can go all the way down. I mean, it's just going to collapse. Where is the bottom? I mean, we could be back in the 50s soon. Look at that. We're going to come back to the 50s. And that's going to be a huge relief to the equity market. So if they do resolve this war, then that 20 VIX may go away Monday. I mean, I'm saying, what's currently on the volatility, it could absolutely change with a headline and will. I mean, they end that war. They're already hedged. They're going to make so much money. They're already hedged. They're hedged long. Where will it go? I mean, they end that war. It's going to go all the way up. And I was pointing this out the other day. I mean, you've just got a wide field. And the 6 month three is at 77.14. That's where it's going to go. 6 month three at the 2. 6 month three, or is this 1.75? 1.75 of the RVOL, quarterly RVOL. 1.75 the quarterly RVOL at the 6 month two. 77.14. 74714. If y'all know what that is. That's funny. All right, I'm showing my age. Okay, don't laugh at me. I'll talk to you guys later. Have a good weekend.